What is financial accounting? Financial accounting is a subcategory of the general scope of accounting that is concerned with collecting and organizing financial data for the purpose of presenting it to the external users in an understandable format. Financial accounting's core objective is to give necessary financial information to the party or people outside the company, or more specifically to the external users. These external users are not directly engaged in operating the business organization like the internal users or the management. They require the financial data of different companies to make a viable investment or financing decisions. The most common external users include investors or shareholders, creditors or lenders, suppliers, customers, unions, regulators, competitors, press, brokers or analysts. Basic accounting equation. The basic accounting equation portrays two particulars of a company, its ownings and its owings. This equation is the base of the double entry accounting concept. The mentioned equation is as follows. Assets equals liabilities plus owner's equity. This equation shows that you can get assets by adding the liabilities and owner's equity, which is meaningful because companies acquire assets by using funds, and liabilities and owner's equity are the sources of this funding. Here, liabilities appear before owner's equity because the company has to pay the creditors before the company becomes bankrupt. For this reason, current assets and liabilities are mentioned before long-term assets and liabilities in financial statements. A business or company always has to make a balance between the both sides of this equation. Components of the basic accounting equation. Assets. The resource controlled or owned by the business for future use or benefit is called an asset. Assets can be tangible such as cash and intangible such as copyrights or goodwill. Receivables are another type of common asset which implies a promise that a payment will be paid from a party to which a service has been provided or a product has been sold on credit. Some common types of assets are mentioned below. Current assets. Cash. Accounts receivables. Prepaid expenses. Fixed assets. Machine and vehicles. Land and buildings. Theoretical or intangible assets. Goodwill. Patents. Copyrights. Liabilities. Liabilities refer to the amount of money owed to another institution or company or person. Payable is the most common form of liability, which is the exact opposite of receivable. It is a promise to pay the other party from which a service is received or an asset is obtained on credit. Some common types of liabilities are mentioned below. Accounts payables. Lines of credit. Bank loans. Officer loans. Personal loans. Unearned income. Owner's equity. The part of the company's assets owned by the owners or partners or stockholders refers to owner's equity. Owners can expand their share by investing money in the company or reduce their equity by quitting funds of the business. Similarly, revenues expand equity and expenses reduce equity. Equity accounts consist the following common items. Owner's capital. Owner's withdrawing. Unearned income. Officer's loan. Paid-in capital. Common stock. Preferred stock. The expanded accounting equation. The owner's equity portion of the basic accounting equation is divided into four parts: owner's capital, owner's withdrawing, revenues, and expenses, other things remaining the same. The expanded equation will be different for different business entities such as corporations, sole proprietorships, and partnerships. The expanded equation for a corporation. Assets equals liabilities plus common stock, dividends plus paid-in capital, treasury stock plus revenues, expenses. Where common stock, dividends plus paid-in capital, treasury stock plus revenues, expenses equals stockholders' equity. The expanded equation for a sole proprietorship. Assets equals liabilities plus owner's capital, withdrawals plus revenues, expenses. Where owner's capital, withdrawals plus revenues, expenses equals owner's equity. The expanded equation for a partnership. Assets equals liabilities plus partner's capital, distributions plus revenues, expenses. Where partner's capital, distributions plus revenues, expenses equals partner's equity. Accounts and types of accounts. Accounts are the base of financial accounting. Any financial transaction expands or reduces balances in one or more accounts/s. The changes in any particular asset, liability, or equity item are recorded time to time in the general ledger, which are called accounts, such as asset accounts, liability accounts, equity accounts. Again, accounts also have sub-accounts. For example, asset accounts have sub-accounts like current assets and fixed assets, liability accounts have current liabilities and long-term liabilities, and so on. Asset accounts, these accounts show a debit balance and record the disposal of a company's resources. Liability accounts, these accounts show a credit balance and record the money that a business owes to other companies or institutions. Equity accounts, these accounts also show a credit balance and record owner's share in the company. The format of accounts. The most common format used in accounting is the T accounts. In the T account format, debits are kept on the left side and credits are kept on the right side, and the total account balance is calculated at the bottom. The T accounts also have a title and number at the top.